Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood Holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions to support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 196. As always, joined by the three amigos. We got the Boomer over in Halifax, Richard Diaz, Montreal. What's going on?
I'm melting.
It's hot over there?
Yeah, it's hot and humid, and I shouldn't complain about the weather because we had probably the worst winter ever. Remember those 4 feet of snow just 6 months ago in Montreal? But it's miserable here. I'm gonna go swimming.
Boomer?
But otherwise, I'm very happy. All is well.
How's the club? This guy's Keith's at the fucking club every day.
On a nice day, I will go to the club. Here in the city, we have a place called the Wag Waltic. That's fun.
What's it called?
My
The Wag?
Wag Waltic. It's
Wives and
whatever,
girlfriends. That's what they call wives and girlfriends in the UK when they talk about football players. Wags.
Really?
Yeah.
You never,
Yeah.
Huh? I didn't know that. But hey, my family, we're really into the Tour de France. So are you guys following the tour? Steve is
I'm not. I do want to see the Netflix documentary, though.
It's amazing.
It's good.
It's amazing, actually.
Yeah, they do a really good job of introducing you to a world it's an amazing competitive sport and there's stuff that goes on. So if anyone is looking for something new, hop on the Netflix one, of course. But the Netflix show is from last year. So you have that. But the live tour is actually started at about 5. They're on stage 5.
You actually watch it live?
Yeah. Or later on you pick it up. We have the pay-per-view Tour de France.
I don't know.
channel.
I'm struggling to think that's entertaining, just watching people ride their bikes for 8 hours. But
So one thing I didn't know about
it's actually really, if you're into it, it's amazing how fit these guys
Steve,
are.
also, what's cool is it's actually a team sport. Sorry, we're getting really we're getting off piste here, but it's what's cool about it is actually much more of a team sport than I ever imagined, which changes the dynamic of it.
Yeah, it's not just a bunch of lads riding their bike, up
Doing
and down
steroids.
the hill and having. It's funny.
well,
they
I'd probably
never
rather watch that than the Habs. So
Hey, shame on you.
there's that. Go Leafs, baby.
Back to hockey again. Here we go.
Yes.
So
No.
as
Summer.
one guy said last week, he said, first 30 seconds of the Loonie Hour, Rich talks about the Habs, Steve talks about the Leafs, and Boomer talks about zombies.
Yeah, I saw that. That was a good comment.
That was a good
Underrated comment.
Okay, Steve, line us up for the week, Steve. What do we got this week?
Yeah, we've got like a recurring theme that we've been talking about in the Loonie Hour for the last couple of years. We've had some guests on, and it's been one of the key things that we've been following, which is this population growth story, the rampant immigration, the fraud in these Ontario colleges, and that's kind of all playing out now on the reverse. It's kind of sowed the seeds of its own demise. And so we're going to walk through some data that's happening, in the rental market, in a government housing agency. I think there's some really, really important takeaways here. And then, wanted to touch on interest rate expectations because those are changing. I think that could really shift people's expectations here moving forward. We've got some stuff
to discuss probably in the UK gilt market if we can get around to it. But yeah, Rich, we've been talking on the immigration stuff.
Well, no, that's a total and unsubstantiated conspiracy theory. I'll tell you what. No, I mean, anyone who's listened to us for as long as this is something we've been on from the beginning. I would say we're in great company. Bob Sacamano, who, as always, is tweeting great stuff on this. I would recommend you follow. Wait, don't follow Bob Sacamano. That doesn't exist. Follow Ben Rabideau, friend of the show. But the thing that it's always fun to sort of be validated, even if it takes 2 years and you've been called, let's say, bad names by all kinds of different people. But this week we had the what is it called? CMHC. What is that?
Yeah, Canadian... CMHC. Which, yeah, I mean, I think first and foremost you had the data from rentals.ca.
Oh yeah, that's right. Sorry.
Which, in my opinion, like they are the best sort of private sector data analysis for the rental market across Canada. So basically they aggregate all the rental data, and they put out, they put out the best data. In my opinion, it's better than the CMHC. It's CMHC is really just like lagging data. But so you look at rentals.ca, the report, it said asking rents in Canada across the nation, they fell for the 9th consecutive month in June. And if you look at basically Canada's 6 largest markets, Vancouver, Toronto, Ottawa, Montreal, Calgary, Edmonton, every single rental market except for basically maybe Edmonton peaked in 2023 and is declining. And so, you can look at the numbers, but in general, like Vancouver and Toronto are down about 10% from 2023. Your 2 largest markets. And of course, that sort of coincides then with the CMHC data. We had this big headline that came out this week in the Globe and Mail saying immigration caps are contributing to lower asking rents in Canada, CMHC says. So CMHC came out with their own report.
Horror.
Yeah, so CMHC came out with their own report as well. Basically highlighting that they say since October 2024, advertised rents are declining due to increased supply, while rents for occupied dwellings continue to rise at a slower pace than a year ago, effectively highlighting advertised rents in Q1 2025 declined between 2 to 8% in places like Calgary, Toronto, Vancouver, and Keith and Halifax as well. So rents are declining across the nation. How could this possibly be?
Well, I mean, geez, our audience knows that we've been talking about it for a while, and that there's never been a housing crisis, and there's never been a doctor crisis or an education crisis. Those are all symptoms of a crisis, and that crisis was, Rich?
Tripling immigration growth. Sorry, tripling population growth via immigration for 3 or 4 years. Totally freaking nuts.
You're a crackpot to say something like that. You shouldn't be. But now though we're actually, but it's one. I mean, but one thing that's great about the world that 3 of us exist in, we're always, we're looking into the future. That's what we're doing, and you're trying to find events significant events that may occur. And the may part about it is we're trying to develop, what's the probability of this? If it's a low probability, then, stuff happens, so you go with it. But one of the easiest outcomes to see in the world, some are very slow moving. There's the whole sort of demographic story. And I have to say, I think, Steve, I think Rich was first on this with us a few years ago, really going into the population story.
Yeah.
And, we were talking about it, and all of a sudden you see the pig move through the python, and everything that should happen with a surging population story. It did happen. And now suddenly the population growth is flatlined. And what should happen after that? Well, of course, the prices of stuff is going to come down. Like in my neighborhood down here, they went with the all across Canada. Remember that housing accelerator or acceleration plan or something. Do you remember that?
Oh God, yeah. That's Sean
Yeah, yeah.
Fraser's masterpiece. Yeah.
So in my neighborhood, I live in a very nice neighborhood, and no one else should be able to live in my neighborhood because it's more beautiful than anyone else's neighborhood. But it is a lovely residential neighborhood with big trees, but they're all single family dwellings. So that's what it is. So this, housing accelerator fund, if I'm not strategy,
Yeah,
am I
you're right.
pronouncing
Yeah.
it right? Okay. All of a sudden they zoned things that you can put in, I think 8 to 10 units. And now we have this monstrosity of a building going up about 3 blocks from my home.
Oh boy, the NIMBYs.
And
Yeah, that's really close, eh? Three whole
it's
blocks.
yeah, well, it is there. But, it's one of these things where there's no parking, so it's like a pedestrian only kind of
Well,
building.
15-minute cities. You're not supposed to drive, Keith.
You're a crackpot, Rich. You can't even suggest
You're
that
always
stuff.
walking to get your lemon loaf. You're good.
I know, or my almond croissant from LF Bakery. By the way, we had a listener sent us an email, and he said Keith is right about that French patisserie shop. It is good. But back to the housing thing. This thing is now going up, and everyone is upset about it. Of course, the neighbors on each side, their houses are being dwarfed now by this thing, and it's happening at the exact point in time when rents are coming down. Vacancies are opening up all over.
I don't
the
think you're
city.
gonna get a lot of sympathy, truthfully,
No,
from our
not at
younger
all.
audience. But
No, I don't mean a sympathy for my neighborhood. It's about the reaction that came out of Ottawa
Yeah.
to fix the housing crisis was, oh, more supply. We need more supply. No, they didn't need more supply. It was always enough supply coming online. They just had to stop the flow of people coming into the country. Now we're starting
yeah,
to see
I
the
mean,
results of it.
I would probably debate that a little bit in some of your larger major metros. I think what we see today is we'd be like, wow, like maybe we have enough supply. I think that a lot of that is sort of just like the real estate cycle playing out. I think if you look at it from a structural perspective, if you zoom out 10 years from now and say, where are we going to be 10 years from now? I'd argue it's going to be hard to say, hey, we're going to be oversupplied. But clearly in the near term, when you have population growth that goes to zero, and you have a scenario where demand is now running at 20-year lows, sales volumes in some of your largest major metros are running at 20-year lows. I don't think that's sustainable, but clearly it was not sustainable on the way up either, right? Having 1.2 million new immigrants coming into the country and
Per year.
and having home prices rising 27% on a national basis clearly was not sustainable. Rents were rising by 15-20% in many markets.
Yeah. I mean, the frustrating thing for me is that there are people who were dismissive. They used quite, I think, derogatory epitaphs on people like me and Ben Rabideau, who on his tweet says, and I quote, "When I testified the Standing Committee on Finance in 2022, I specifically flagged the temporary residents as a major factor in surging rents. He was then ignored and vilified." And then it's amazing how, what is it, almost 3 years later, the official government, because that's what it is. The CMHC is basically an arm of the government in some capacity. I mean, it's supposed to be independent, blah, blah, blah. But ultimately, it is funded by the government. And now we know, and, they in the paragraph, I don't know what page it is, over the rest of 2025, the rental market is also to be influenced by slower population growth and changing employment conditions. And so, that's what's so frustrating for someone like me, Keith, and who is basically, our job is effectively to predict the future. The data is out there, all this employment data and population growth data is on the StatsCan website. It's on DataStream. It's on Bloomberg. And people like me and Ben, who devote our lives to studying it and combing through it, when we flag things, it's not because we're racist or crackpots or fringe or what have you. It's because we care about Canada and we're committed to getting these kinds of things right. And yes, we do make mistakes, but this was such a stupidly obvious one.
Yeah, but
and
Rich,
to see
I think it just
unwind.
highlights the previous administration. Obviously, there's still a lot of the same faces that are in the current administration, but I think it just shows how misguided they were. And I think the funniest thing is like that, right? Is like back when you started flagging immigration in 21, 22, like it was clear as day in 21.
Yeah.
And people were like, well, that's xenophobic. You're against, immigration. Immigration built Canada. We heard the same things though in 2016, 17, 18 around foreign buyers influencing home prices in places like Vancouver and Toronto. People that were in the industry, such as myself, that see, who is transacting on these homes. And you're like, wow, there's a lot of offshore capital, particularly from China, flooding into this market. Oh, and by the way, some of it looks to be illicit, Sam Cooper. And you were flagged as xenophobic, and the government says, no, it's not a problem. CMHC says not a problem. And then what, in 2023, the Trudeau government came out with the national foreign buyer ban.
Yeah.
It was like 5 years later after everyone, and they had basically, the foreign buying had essentially already slowed to a trickle at that point. And then they brought the ban in. So it's just, I don't know. It's just classic, the horse has already bolted the barn, so to speak.
Yeah.
And that's kind of where we are today, obviously, with immigration and population growth stuff.
This episode is brought to you by Square One. I recently tried them out myself. Getting a quote took less than 5 minutes, and the whole process was smooth and painless. What stood out most was how customizable everything is. Most home insurance policies bundle in coverage for things like jewelry or expensive artwork, whether you own them or not. With Square One, you only pay to insure what you actually have, so you're not overpaying for stuff you don't own. Plans start at just $15 a month, and you can manage everything. Quotes, policies, claims entirely online or through their app. Head to squareone.ca/Loonie Hour and get a $20 account credit. That's squareone.ca/Loonie Hour.
But this is all, so the conversation that we're having today, everything is tied together. Nothing is in isolation. And, because the view that us and other people had on the population story, it's now been confirmed. Yeah, that view was 100% correct. We want you as our listeners to appreciate now what we view as another high probability event that's coming, because now we've had the population growth has been flatlined in Q1. I don't know what Q2 was look like. Have you guys seen any?
It's not out yet.
Same?
It's not out yet.
I know it was not out yet, but have you seen any suggestions? No?
It'll be low.
You don't have your ticker at the airport?
No, I don't know.
Rich,
I don't know what
in
it is.
Montreal?
When the data comes out, we'll report it.
But let's talk about that, because again, people need to know that, the more people coming into a place, there's more people are spending, borrowing and stuff, and any supply that is inelastic, and that's just a real cool economic class term. It means if something is inelastic, it means it's very difficult to expand or to contract very quickly. Right? Think of an elastic band. Think of it that way. And the housing market is inelastic. It takes a really long time to ramp up. But we'll tie this into because we have a budget conversation coming up as well, and it's all going to be linked. So again, we're just telling you, don't put things in different compartments and isolate them. It all has to blend together.
So I want to just bring that sort of like full circle. So again, you had rentals.ca. CMHC, both data sets confirming what we've already known for, anyone in the industry has known for 18 months. Rents peaked quite a while ago, and they've been declining since. And this kind of plays into a story or a theme that we've been talking about in the resale housing market, which is you think about all these mom and pop landlords, right? Where a lot of them were adding to their portfolios, right? Buying a second or third condo in 21, 22, near the tops of the market, because you had rising prices, rising rents, and everybody saw what was happening with immigration, that a lot of these investment decisions were made with that data in mind. And I think what we're seeing now is when you look at the weakness in the resale market, the weakness is almost not exclusively, but predominantly concentrated in the condo market. And that's because that's where all the investors are playing. So you're just seeing record number of new listings coming to markets, as a lot of these landlords are now choosing not to buy, but they're actually choosing to, in addition to that, they're choosing to add to sell. They're choosing to lighten up their portfolio because, hey, my tenant just moved out. I was getting $2,400 a month, 2 years ago. Now I'm putting it up on the rental market and I'm not getting bites at 24. I'm not getting bites at 23. I'm getting, I've got a few people opting in with applications at 2,200. But like that doesn't work because my mortgage has gone from 1.5% to 5%, and the numbers just keep getting worse. And so this is what I'm saying is it all kind of ties in to the resale market. Like you're gonna obviously as an investor, if you look at that 1-bedroom condo and it's getting you $2,400 a month, you're gonna pay a different price than if it's getting you $2,200 a month. And so this is what we're seeing, obviously impacting the resale market as well. It's not only that, but if you think about what I'm seeing on the ground as well, is you see a lot of these because the tenancy laws are so strict, specifically in places like Montreal, Vancouver, Toronto, is when a tenant leaves, it's like an opportune time to then list the property for sale. You now have a vacant property. And specifically, I'm seeing more and more people where they're trying to rent it out, but it's now sitting vacant for a month, 2 months, 3 months, trying to fill the vacancy. And as a small mom and pop landlord, if you're missing out on $2,400 a month in rent every single month for 3 months, all of a sudden you start getting into a real crunch.
How long do you think that, I think in general, like, so let me use a US example, which is housing, depending on the jurisdiction, of course, peaked in like late 2006, actually.
Yes, correct. Yeah.
But really the pain was really only felt like almost 2 years later, let's just say, round numbers, let's say 2008. What would you I know this is sort of an impossible question, but what would you ballpark Canada's ability to withstand that sort of pain that you've outlined, which is higher mortgage rates, weaker rents, if you're renting it at all, all that kind of stuff? Because I think, we're often guilty of it as strategists, being early to an issue, as we've demonstrated, and then sort of not being respectful of the fact that it sort of takes time to seep through the the zeitgeist of a country or of a market, etc. So how long, where do you see us in this path?
Yeah, I think it just compounds the problems moving forward. I think it just delays like a recovery, right? Everyone's so short-sighted in Canadian housing because everyone's just used to like a 30-year bull market where every correction has been like 12 months long and then you're back into a new bull market. So every market in Canada, almost basically every market peaked in early 2022. So I'd say most markets peaked in February 2022, precisely a month before the BOC decided to start hiking rates, ironically. So what are we're over 3 years now into this correction. And so, there's a lot of charts now circulating on Twitter showing like, the GTA and the 80s correction and how long it took to recover, in real terms, adjusted for inflation. And it took close to it was like 20 years. So I think I think it was about a 10-year correction in nominal terms and about 20 years in real terms.
Yikes.
And I'm not saying like that's where we're going, but I mean, the probabilities that this is a much longer drawn out correction, like we're 3 years into it. Could it be another 2, 3, 4, 5 years? Yeah, maybe. Where you just have this like slow grind, sort of flat, lower, sideways, whatever you want to call it, I think is a very realistic probability, given where if you look at, okay, population growth probably isn't going to rebound in 2025. You look at the pipeline of units that are under construction, which I think we should get to, is not only condos, but specifically rentals. You have 7% of all rental housing that's in sort of available in Canada. 7% of that is under construction right now. So you've got a record pipeline completing over the next, call it 24 months. So it's going to be a well-supplied market for the next couple of years.
I think we also have to consider with that, Steve, is again, we're back to this population story. So now we have no growth, no new people are coming in. You obviously only get some coming in. That's going to happen, but that was a major buyer of stuff for our economy. you know,
Mhm.
housing, healthcare, education, you know, Twinkies and stuff. And now that's gone. So that now we're back to organic growth. And so organic growth is for a family. If your income is not changing, you know, what are you using to is what you're buying on a regular basis, like groceries, for example, and so forth. To buy a new house, then yeah, there's you know you're going to do that's a cost with it, but that headwind that Canada has experienced over the last decade, that's gone. That's not coming back unless you know the government makes another you know they do a 180 with population growth, which you know it could happen. You know we could have that. But if we don't have that happening and the economy is just grinding along, then again that's another negative with it because then you're not getting great job creation. You know you're sort of
Or
flatlining.
tax
So
revenue.
yeah, absolutely. And tax revenue is going to be a bit lower relative to what the government has to spend on interest expense. So, and again, that's because you know, we're running bigger deficits. Debt is rolling over from a low rate to a high rate and that stuff. So then now we're back to that, you know, sort of financial bazooka, you know, phrase that we didn't coin it, but I think we brought it to the surface there a few
Definitely did
weeks.
not coin it. That's from
No, but
that's from Mario Draghi. Remember
I
from
just
Fiscal bazooka.
yeah, in the
I don't think he
mid-teens, I think.
said it. I think he was he was described it.
Yeah.
It was described as him doing it. But that's my point. So, you know, the governments, I hope they know this by now. Population growth gone, you know, and
Productivity gone.
yeah, as we used to say growing up, there she was, gone. You know, there's not a lot of positive momentum here at all for the Canadian economy, nor is there for you know for the Europeans and the Brits and you know Americans and Japanese and everyone else. So then we come back to, hey, let's get ready for this new, you know, budget because this is the only way that governments are going to be able to stimulate the economy to try to keep the housing market, you know, where it is, you know, from the guy, okay, I can swallow $200 a month, I'll eat that. But if it's 300 or 400, at some point, you know, it really is taken away from not only discretionary spending, but of course, you know, another thing for people to realize, one person's debt is another person's asset. So if the housing market does go in a severe tumble anywhere, someone is eating a loss on it.
Yeah, but wait a second. But there is like that's true, but a lot of people own their home outright. Right. And
We're not
we
talking
don't
about them. We're talking about the people who are levered, that they
Yeah,
own the
okay.
like the apartment
Yeah.
buildings or
Oh, yeah,
multiple
gotcha,
units.
Yeah, it
and
won't be the
stuff.
boomers impacted.
Yeah, the
You wanna
boomers
know
are
crazy,
great.
you wanna know crazy stat? In the
Not in
city
my
of,
neighborhood. My neighborhood, we're fine. We're just ticked off with the big building going up.
yes, well, I can tell you this: in the city of Vancouver, I believe it's 50% of all single family houses. And there's a lot of them. 50% of them are owned mortgage free.
Wow.
This
Yeah,
is
they
just
don't
like
care.
old. Yeah, it's just old boomers that just they bought it 35 years ago and haven't moved. And but then you know obviously there's a lot of debt in the housing market. It's just not in that product. And,
Yeah.
and you know it's the investor that levered you know multiple condos that is getting squeezed.
Oh yeah. I mean, but that's what's so fascinating about all of this, like population growth, the housing unaffordability stuff, like you know, lack of productivity, the NIMBYism. It's just like it's just like class warfare. If you're
Yeah.
old, you're sitting pretty, pension, you've got, you know, you've got I'm not gonna say it. Anyway, you're doing very well. And if you're young and working class, you've totally gotten shafted by these government policies. It's fascinating.
And
I'll just
it's
say it.
happening at the same time at the end of a 40-year cycle,
Right.
with rates going from 20% to zero. So people should, younger people should absolutely feel,
Shafted.
yeah, shafted, you know?
Remember
And
remember we had Greg Robinson, who's the new housing minister of Canada, that you know fumbled the ball a week into his job when he was asked if house prices should come down. He says, no, I don't think they should. Right.
Well, it's because he's got an
Um,
$11 million housing portfolio, you know? He's talking his book.
Yeah, no, but I mean, it's just
I'm
obviously
teasing, I'm teasing.
they know their voter base, right? I mean, it's the elbows up crowd. It's
Yeah,
the
of
boomer
course.
base, but so it's interesting. Obviously, we know the
It's so
government.
funny. I was chatting with one of the neighbors in the with that big building that's going up, and they're just disgusted with everything. And of course, me being me, I said, "Who'd you vote for?"
No, you didn't.
Of course, I did.
What did he
And
say?
and the look on the face was, "Huh? Like, what does that got to do with anything?" You just go.
That's hilarious.
That's
But
Loonie Hour. That's Loonie Hour logic, right? We
again,
connect it all
from a
together.
federal perspective, both the conservatives and the liberals campaigned on loosening up zoning, removing red tape, and adding more housing supply. That was the narrative, right? Which is
Yeah.
like we need to build more housing in Canada. And so to that point, as we kind of round out this sort of segment of that conversation, there's something that's really interesting. We talked about CMHC, they're flagging declining rents, right? They've been the number one lender on
Oh,
all of
yeah.
this rental construction. So the one thing I'll give the Liberal government credit for during their tenure is they introduced a program called like basically it's CMHC rental construction financing. So what they did is they basically turned CMHC into a lending arm or securitization.
A bank.
Yeah, a bank essentially. I mean, they basically a big bank will basically how it works is a big bank will issue the loan. So TD Bank issues the loan, CMHC guarantees that construction loan, and then the rental housing gets built. So the terms of the financing were so attractive that what it did is it spurred an all-time record high in new rental apartments being built. So if you want new housing being built, this program was successful. Basically, what it allowed developers to do, if you hit their metrics, which were relatively easy to hit in most major metros, you could effectively build a new rental apartment building, 95% loan to cost. So very little capital required up front, 95% loan to cost. On completion, again, assuming you hit the relatively easy targets, you could then do a 50-year amortization, 95% loan to value, and with very favorable rates that were, call it, I don't know, roughly 50 basis points below the market, because again, it's a subsidized loan. It's insured by the government. So it was considered, risk-free basically. And so that brought the rates down essentially. So this program is basically what has spurred all of this rental construction that is currently in the pipeline. But it's almost been so good. The program has been so good and so effective that it's actually sowing the seeds of its own demise, which is to say, like, falling rents really impact the pro forma.
Valuation.
They really, yeah, exactly. They impact the pro forma, the valuation, the debt servicing ratios. And so it's now becoming a problem where CMHC, who's lent all this money out, is saying, "Oh man, maybe we have a bit too much exposure here to the rental market."
Steve,
To
I
the
have a
fact
question.
yeah.
Oh, sorry. Go ahead. Sorry.
Well, CMHC, by their own report here, went from. So I'll give you this. So if you look at all the rental apartment construction financing in 2017, CMHC owned about 5%. They owned about 5% of the book. They're now at 88% as of 2024.
Jesus Christ.
So they are like the only basically financier in town.
Oh boy. So I have a question. About this. So if there's losses on these guaranteed loans, two questions. One, do the equity holders take any hits?
Yeah, these loans are typically all, to my knowledge, they are you have to sign a I'm drawing a blank, personal guarantee essentially.
Okay. So a corporation needs to put up some equity, and if that corporation,
Well, you got to put up your equity, yes, but I mean basically it's, I think a lot of you're going to have to come up with like cash injections at the end of the project, because the numbers it's not going to debt service properly, right? If you have falling,
fine.
like if you, I mean, in very, very simple terms, if you at the start of the project, you're in what, 2020, let's say 2023, and the rental market is like an all-time high. And you're like, wow, rents are $3,000. We're going to average $3,000 a unit on the rents. But by the time this project is done, in call it 2 years, the rents won't be 3,000. We'll call it, they'll be 3,200. And so so CMHC obviously, has issued a lot of loans on the basis of the rents being 3,000 or even increasing up to 3,200. And what we're seeing now is the rents aren't 3,000; they're now 2,800
or 2,500 or 2,000.
Yeah, I mean, I don't say they've come off that much, but basically, so now as the lender of the project, you're going to the developer and saying, listen, you're not getting 95% here. You need to come up with $1 million or $2 million or $3 million of additional capital, because your pro forma doesn't make sense anymore.
Crazy. I guess my point is just like this. I mean, a lot of these government programs are basically transfers of wealth from the government to asset holders and rich people via subsidized lending. I mean, this is one of my big beefs with almost all government lending, full stop. And why I'm against negative real interest rates. And
I would say you're correct there, but then the argument is like, well, it's also created a hole of the supply, which is now driving rents down, which is good for your end user.
Right, which is almost certainly a working class person, because working class people
100%.
overwhelmingly rent, and rich NIMBYs like Keith buy and own.
Keith would own the apartment building.
Yeah,
and then you're working class with
10. I would own 10 of these suckers.
You should buy them right next to your neighbor.
Anyways, what's been
I actually own the building. I'm the guy that put it up, actually.
Which is interesting though, is over the last, call it, week and a half here, is so now the CMHC realizes they've got a problem, which is like we have way too much exposure. Like, it was a great program, but it was almost too good. That everyone just took advantage of this program, is they've now actually raised their insurance premiums on this product. So as a developer, you're now paying quite a bit more. Actually, it's quite a significant increase in the insurance premiums.
I have another question. Does the CMHC then securitize these loans and like get them off their book, or does the CMHC have a big balance sheet?
It's securitized.
And so then they just sell it off to a REIT or like a pension fund or whatever. Like, just
wait a second. I don't think this is a stupid question, maybe, but they're not making their loans. They're just putting the insurance on it.
Yeah,
someone else is like, Rich. They're not lending the money. Like the banks are lending the money.
Yeah, the banks are lending the money. CMHC,
the banks have it. They would securitize it.
Okay, sorry. Okay, sorry. I didn't understand.
Yeah,
okay,
correct.
So CMHC doesn't have a big balance sheet. It just insures these loans.
They have liabilities.
They have liabilities.
Okay.
And I'm not sort of affluent as to the interworkings of CMHC's balance sheet. Let's put it this way: I don't think it's a major problem, but it's enough of a problem that clearly, when you own 88% of the float, I mean, that's a lot of exposure.
Yeah.
CMHC has been a profitable entity for years and years and years and years, and remits back to the federal government. So the listeners are like, oh wow, the taxpayer is gonna eat the loss on the, I don't.
Sounds like me. That sounds like something I would have said. So that's not happening.
No.
Okay.
But it's something to watch. I mean, if you have this catastrophic event, sure.
Yet.
Well, we haven't. I don't think it's it's easy to dismiss it.
No, I understand.
Yeah, we haven't had a recession.
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy SIM sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans to fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, No contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off.
Maybe we won't have one.
Just to summarize,
But yet, although, have you considered maybe?
Nevertheless,
but just to summarize all
That's
that,
a good
right?
one
It's
too.
like the government continues to come out and say, we need more housing, we need more supply. We're going to build 500,000 homes a year. Yet they're behind the scenes, they're tightening the screws on their most successful financing program of new
they're
supply.
not that smart, Steve. They're just not that smart.
Well, but I think it's the right thing to do, and everyone's like, "Oh my god," But I think it's the real estate cycle is playing out, which is like, listen, we had a massive boom. We overbuilt because people started making investment decisions on the basis that population growth was going to be sustained. Rent growth of double digits was the new norm or whatever, and it's all unwinding now.
Cool.
But Steve, you mentioned, I did it again, hey, but by the way, I hate that word. I rather use but Steve, the key word that you just mentioned was the word cycle, the business cycle. Because I would argue the business cycle it didn't exist for over a decade. It wasn't there. And now, because we had zero rates, free money, and all that stuff happening. No one knew what risk was because no one had losses. Now we're going back to a business cycle developing, and we happen to be that part of the cycle where we're going down, where all the excesses have to be cleansed. So it's normal. It's not pleasant, mind you.
Yeah.
It's not pleasant. However, it needs to happen. And you get cycles and everything, not just the economy. You get it in sports, for example. Like, yeah, Rich, the Canadians will win again sometime.
Hooray, maybe one day.
I don't know when, but
so then can I have a question? Maybe this is a bit of a segue, but then why? So if the cycle is slowing, and tomorrow we're going to get the employment data. We recorded this on a Thursday. It's released on a Friday, which I think unemployment is going to go up. That's what the consensus economist expectations are. Then why are bond yields rising? That's my question.
I think we should get into that, because if you look at again, I look at this full circle on I want to touch on what Carney's got planned here, but we had like Toronto's so we talked about the rental market, but if you look at Toronto's housing stuff too, it was reported last week that there was 42 new condos sold in the entire city of Toronto for the month of May. That's on the resale side.
Wait, what? The whole
the city, not the GTA region, but the city of Toronto. I think the average for the month of May is typically around 2,000. They sold 42 condos.
That's bananas.
But like, it's bananas. So like the resale side on the new construction pre-sale resale side is dead. Where Altus Group, which is the main surveyor of all this data, is saying, listen, if this continues, they're going to lose 40,000 construction jobs in the GTA.
Wow.
And
that's big. Those are big numbers.
And like I said, now CMHC is saying, oh, we're going to tighten the screws on the rental side. So I just think the construction sector is in for a serious bear market. And I do think the job losses in that sector, I think, are going to be pronounced. Which probably sows the seeds for your shortfall of new housing getting built over the next 3, 4, 5, 6 years.
Yikes.
But that coincides with we're learning, about those job layoffs that are happening, and they're going to continue. What about the Carney government, which, we're reading in the news here that per the PBO, Parliamentary Budget Officer, the Carney government aims to slash spending by $25 billion. And there's now memos being sent out in Ottawa. One of the largest departments in Canadian government told employers they may face job losses as Prime Minister Mark Carney searches for spending cuts to keep the budget deficit contained. Top bureaucrat at the Employment and Social Development Canada sent an email to employees on Wednesday informing them the department will be reviewing what it does. Given the scope of requested spending reductions, adjustments to our workforce may be necessary.
This sounds like the beginning of the original movie, The Office. You know, when they're going through to find efficiencies. You know, people hearing this thinking, "Oh wow, man, they're going to reduce the budget and everything." I would argue they're trying to prevent it from going over 100 billion on the deficit.
Yeah,
That's
it's gonna be
the
massive.
yeah, and these little things, you know, and oh wow, yeah, this yeah, he is different. This is amazing. We see where what happens there, but the but
I'll believe it when I see it. Why why are we taking this at face value? I
Oh,
mean,
but something's got to be done, right? I mean, we've you know I think a lot of the expected revenues initially were through like the carbon tax, the increased
oh, the tariffs, elbows up. Remember
the
the $20
tariffs,
billion
increased
that
capital gains.
vaporized?
Yeah, but like a lot of these revenues that were initially projected have been unwound because they've canceled these policies, and you know he's committed to increasing national defense spending,
Yeah.
which is, I don't know, Rich, you would know the numbers. I mean, it's significant.
I mean, the national defense thing is just never going to happen. I think that people need to stop believing that. I mean, the commitments were 5%. 1.5% is just like this gooey, mushy, nondescript, everything's included, but nothing's included number. So let's ignore that. And then there's the
was
3.5%
that
under the
gooey mooey? Was that a fourth year university course? You learned that?
I mean, listen, I just read the NATO release. It's publicly available. Anyone could read it. The 3.5% is the real number, and that's based on like the old time definitions of bullets, butter, and guns. You know, like and then there's the 1.5% that's just like all this bullshit that they're gonna. So if they spend on a mine and a road to nowhere, that's going to be included. Who knows?
So, I mean, an interesting thing with this, okay, here's a positive. If just say you're running a business or you're running a government and you only have so much money that you can spend on stuff. For a business, you know, you have certain costs that are fixed or the core, the critical for your business. So you can't really change that a lot. And then on your other parts of your business, you try to move away from low margin products or services, reallocating to higher. So maybe with, you know, Carney's directive to the government, hey, I want you to I want Steve, your department to shave off, you know, X billion in expenditures of, maybe that's what they're doing. You know,
and it's not unreasonable. We know that public sector employment as a percentage of total is at a 30-year high. We know that public sector productivity growth is at a 10-year low. We know that employment from the public sector has dominated. It's been, I think, 33 or 35 or 40% of all total employment growth from 2023, I think. I'll share the charts if you guys are interested. And so there's been obviously some bloat. There's been some bloat there with respect to the employment stuff. And you're right. I guess we could be more sort of. I mean, let's just be positive. Everything's going to be great.
Now, do you think the memos that they sent out, the old ones, would have had the white, the pink, and the yellow paper, and they wrote on top a triplicate, and they were sent out?
Yeah, I don't know. I think there's like something else to unpack here, which is there was like all this fear mongering. Again, forgive me, but you know, before the election, there was all this fear mongering with respect to you know, Pierre Poilievre is going to come in and he's going to throw all these people out of work, and it's funny that Mark Carney has tacked right. I mean, he's increased defense spending. He's supposedly greenlighting pipelines and other sort of natural resource projects. And now he's supposedly cutting the federal workforce. So it's kind of ironic, basically, that
The
this guy's doing all that.
The finance minister has been ordered to federal spending cuts of up to 15% by 2028, 2029. Assuming they actually hit those, against all hearsay at this point, it would be the largest cuts in history.
Yikes.
Okay, let's move on. But my other suggestion for governments with this stuff, you know, you're giving, you know, let's cut it by 10% by this, like 3 to 4 years later.
Yeah.
Well, they grew it so much, and now
do
they're
it that
cutting
way.
it.
You say, hey, okay, let's do 3% a year. They have this big number, they push it out, and it doesn't happen. Like it never happens.
Well, it's funny you should say that because, remember Argentina's new president or prime minister? I'm not sure who runs that country, but Milei. A couple of years ago, he came into power, and of course, everybody was screaming bloody murder. Remember the guy? I mean, and not unreasonably so. He was walking around with a big chainsaw. And people said, "Oh, the economy is going to be in the shitter. It's going to be a disaster." Blah blah blah. Ironically, there was an article in Bloomberg today or yesterday about how not only is their economy doing much better after he cut spending by, I think, 31%. They removed rent controls. They slash bureaucracies. Now, I'm not suggesting that. And inflation, crucially, inflation, which was literally like tens of thousands of percent in Argentina, not even kidding, at some point, is now down to 1 or 2% per month, which is still crazy,
Still high, yeah.
but still is much, much, much lower. And it's amazing to me how, he was vilified for those, in my view, insane and somewhat drastic cuts, but actually the proof is in the pudding. I mean, their economy, their poverty levels are starting to go down. The growth is back up. Inflation's okay. There's more housing supply coming online because they got rid of the rental controls. So it's just a little bit ironic what the headlines we read versus the sort of the live experiment that we're watching, and then we're
So
just
Rich,
watching.
Well, and the good thing about that, and not but the changes that they implemented, it's attracting foreign investment to come into the country. So by the way, Argentina was the classic case of there was a book out a long time ago called Confessions of an Economic Hitman.
Yeah,
I think I've heard about that. I've never read it.
Yeah, I've read that.
Perkins, I think the author's name. Yeah. So Argentina has been put through the ringer by the IMF and all these other bloated, four-legged figurative
swamp creatures
with little wiggly tails and everything at the trough. And he upset that cart. That's what he did. Yeah. That's why the whole world went against him, including the media. Yeah, as well as Bloomberg, especially. I know we mention Bloomberg all the time for data and stuff like that, but boy, they have a significant foothold in what they want the world to hear on their views.
Sounds a lot like the CBC.
See that?
You're
I'm surprised it took us that long to get there.
Oh,
crackpot. Did anyone talk about job losses, or did anyone walk away from the CBC this week?
Yeah, Travis. I don't really watch CBC. I don't know how to say his name. Travis Derange.
I think so.
Anyway, I guess he was one of the anchors there for.
He was a senior correspondent. Yeah,
he was there a 20-year broadcast veteran. That he resigned or he got fired. I don't know. Anyways, he went out. He went out with a thud, which is to say that he's accused the CBC of bias, a lack of diversity of opinion, scathing resignation.
Never.
Oh, he says, I'm stepping down, not by choice, but because the Canadian Broadcasting Corporation has made it impossible for me to continue my work with integrity.
Yikes.
I mean, apparently he was saying that he was stifled or just dissuaded from bringing on conservative politicians, particularly during the election cycle. Shocking.
Yeah, obviously. I mean, come on. No adult. Even the most commie Ottawa federal government, it's obviously biased, right? No one's under any impression that they care to be even perceived as fair and balanced. Is anybody, or am I just totally, in my own echo chamber? Am I just fringe with these opinions, Steve? I mean,
well, I mean, I don't know. I think anyone that listens to this podcast probably shares our view, but maybe we're our own echo chamber at times.
Yeah, maybe.
It's a damn good one too, guys. Don't let it change. So we have to go to the interest rate story. I think, Rich, you introduced it, or Steve did.
Yeah,
we have this important conversation today.
Well, I wanted to ask, because we've kind of talked about Canada and the precarious situation we're in. Housing sucks. There's no population growth, which means how are you going to drive any nominal growth without population? Productivity stinks. So you're kind of like, wow, man, the outlook for Canada doesn't look very good. But Rich, interest rate expectations have changed rather dramatically over the last number of weeks, which suggests that the interest rate market or the betting market seems to think otherwise, that growth might just be okay.
Yeah. Well, I mean, it's important to people know, not to get too technical here, but when you're thinking about like a short-term interest rate, it's very much what policy expectations are going to be, right? More or less. Okay. There are some credit components, et cetera, but let's just leave that aside. So when you think about the front end of the yield curve, you got the front end, which short, long end incorporates a bunch of different factors, which you have a term premium, which means like literally how much term is included in the bond issuance that you're giving or buying. And then there's like obviously a credit component. But let's leave those two aside. Ultimately, you have growth and inflation. And so so you have a bunch of these little components. You have credit, term, growth, inflation, and that's at the long end. And what we're seeing is slowly but surely the long end of the curve, that 10-year bond yield is starting to rise. And that also means by extension that the 5-year is also rising and the front end is also rising. So you have the whole yield curve rising, which tells you sort of a bunch of different messages depending on what part of the yield curve you're in. And so at the front end of the yield curve, it tells you that a lot of these rate cuts that we were certain about, we as in Loonie Hour were certain were going to happen just a couple of months ago. Remember, we lost a Twinkie bet, although Keith hasn't had a Twinkie in like 2 years, which is kind of annoying. But we were certain that, and wrong. We were certain and quite wrong that the BOC was going to cut, et cetera. And so they didn't cut last time. And now the expectations based on the overnight index swap, which were about 50-50 maybe a month ago, are now 75-25 for a no cut. So that's at the front end. And then as you go down the yield curve, which is the 5-year, right, Steve, where the mortgages are being priced at, that's starting to grind higher. That includes a kind of a growth, quote unquote, growth component, a term premium component, and an inflation component. And then certainly the 10-year, and never mind the even longer, like that's just off the chain. So what is that telling us? Keith's going to tell his view on that, I'm sure. But like, it's really funny how this is, I think we've seen the low really for now in the yield curve.
Did you just call the bottom?
No. Oh, fuck. Anyways, who knows? But like my point is it's something I'm paying attention to every single day. In our Loonie Hour WhatsApp group, I keep sending the chart, and maybe we'll share it with you guys today. But like, it's something has changed in sort of the quote unquote mentality of the market, Keith.
Before we jump over to Keith, I want your commentary, Keith. Rich, the Canada 5-year bond yield.
Yeah.
So right now it's sitting at 2.95 today.
Yeah.
That's literally what it was at the start of the year, January 2nd.
Interesting.
2.95. So
we've done a round trip basically.
Yeah. Right? It's kind of just bounced around, but effectively it's unch for the year.
How low did it go? Guys?
I got down to about it got down to about 2.45 in April. And it's kind of just been chopping around, but we're back down. We're back up now to 2.95, exactly where we started the year. So for anyone renewing your mortgage, 25, 26, that's the big renewal years. Not a whole lot of movement.
No.
Keith, what are you thinking?
Yeah, so what I love about the interest rate story that Rich just shared, it's not just Canada. Rates everywhere. Remember last week, Rich with his brutal British accent described what was happening over in Britain. But I think with the shift in the yield curve higher here in Canada, again, it's not a Canadian specific story. It's global. Like, we are literally living on this global yield curve. And so, Steve, you mentioned, maybe it's because of growth expectations. I would say it's something different. I think now markets are starting to get concerned with sovereign debt, because again, you had that UK scare, with their budget or with their size of the deficit. And remind everyone in Canada, I think they've tried to eliminate the word deficit or budget from Ottawa. So no one even talks about it. It's just shocking, again, how no one brings this up except for a bunch of crackpots, that's it. So it is a very important data point. But the Americans came out with their big budget as well. I know the French are having challenges domestically. So maybe, Steve, the rise in the whole yield curve here, maybe it's not because of better growth expectations. Maybe it's because investors are saying, wow, I think I want to get paid a little bit more money for holding your debt. Maybe that's where we're going here.
It's also inflation, though. I think that's part of it, right? I mean,
Yeah.
so if you want to be like, so there's some, bond hedge fund strategists, people who, they can split out and cut up every single part of the bond yield based on modeling and regressions and a lot of funky math, to figure out what part is what. And I think it's mostly theoretical. I hope I don't get any hate mail from saying that. But I think a lot of it, Keith, is also inflation. I think if you cannot rein in your budget, certainly the US can't. We know France can't. We know the UK can't. Germany is going the opposite way. After years of being austere, they're actually going to spend lots of money. Inflation is going to remain sticky, right? 3 is the new 2. This is something we actually did get right many, many years ago. And I think in Canada, it's the same. And I think that's what's partly reflecting. So maybe it's partly that. It is a credit component, Keith, which people are demanding a higher yield rather, on sort of the risk or the issuance that they're purchasing. But I think also it's partly inflation. And we saw that in the core data. Remember the 3 preferred measures of core inflation that came last month. We'll see it again, I think, in the next couple of weeks. But I think it's also part of that.
So you talk about, the little tidbits, not tidbits, remember that birthday
Tidbits?
cake one I had?
Timbits. Oh my God.
Remember? Yeah, I know I'm jumping around here.
Timbit.
Timbit?
Yes,
Timbit.
it's a Timbit. It's from Tim Hortons, a coffee shop in Canada.
We had them on the boondoggle. No,
Yes,
sorry,
yes,
not
it's a
boondoggle. The
Timbit.
business trip that we did. Where the heck was I going with that? So, but along the way, thin thing, you see little Timbits lying around, little pieces or clues to where the puzzle is going.
Oh, brother.
And we, now all of a sudden we're getting bigger pieces. Now we're getting like full donuts coming in.
Oh my God.
But the population growth story, we're now starting to see rental prices come off. It's making sense. Now we know that economic growth, it's going to need something to really push it higher. Meanwhile, inflation is sticky, and now rates are going higher. So we are continuing to go down this path. And I don't think it's going to end with a real nice sunset on the wharf up there and on the lake. But again, this is what we're looking at here. So it is a Timbit then.
And there's
right?
one more thing. Sorry, I forgot to mention something. The reason I think we care a lot about bond yields, other than being nerds, is because Canada has an incredible amount of debt that's coming up for renewal, right? Which makes sense, right? Just like a mortgage might be coming up for renewal, a Canadian or any government, will have a bunch of debt that's issued at, say, a 5-year paper, or in Christopher Freeland's infinite wisdom, 1-year or 2-year paper, right? And but anyway, so you have she didn't deserve a strike. She's no longer finance minister. But anyway, my point is that there's lots of debt that's coming up for renewal, right? It was issued many years ago. You issue a bond. It might be a 3-year bond or a 5-year bond. You might pay a particular coupon at the end of the term. You reissue that bond to the market. So the situation we have in Canada is we have, I think, something like a third. I was looking at the Bank of Canada data the other day, something almost like a third of all the debt issuance, at the federal level will have to be reissued in the next 2 years. So this year, 2025 and 2026. And so that's, we have about a 1.4 trillion of federal debt. A third, Loonie Hour math, a third of 1.4 is, let's say, roughly 500 or so over the next 2 years. And more, lower, anyways, whatever. And it's being done so at, again, it's going to be refinanced at a much higher yield, right? Remember, just 2 years ago, the yield curve, was stuck at 1% or what have you, and now it's in the 2s, the 3s, and even 4s, depending on where you are. And what that means is it's just going to be much, much more expensive to refinance it, and their interest expense, right, which makes sense, how much you have to pay, your mortgage costs, right, versus the amount of debt you're borrowing means your interest expense is going to be much, much higher. So it's going to gobble up an even higher or a larger proportion of your federal government revenues. And so that's why we really care about it.
And this goes to the budget that might come out
Right.
at some time. So even though they're cutting spending in other parts of their budget,
Allegedly.
they know that the interest expense is going to be higher.
Yeah.
And that's a mathematical fact. That's not, some weird thinking.
Yeah.
So it seems like you've got the mortgage renewal wave in 25, 26. You've got the government renewal wave. So it seems like everybody's kind of in the same boat.
Yeah.
Which is to say there's a lot of debt outstanding, a lot of which will be renewed or refinanced, call it a refi wave in 25, 26. So if I'm a policymaker, seems logical to try to either A, get yields down, which is looking challenging, or two, to basically debase the value of that debt, which seems like they're doing through all this fiscal stimulus that is being announced.
There's another way to do it, which is to raise taxes. Now, you could just to be clear, Canada's federal tax take as a percentage of GDP is at a 25-year high. So hopefully they're listening and they don't raise it even higher, because I'm not a big fan of high taxes. But
this ties into the British experience, story that just came out. And so within their budget, they were anticipating so many, they call them millionaires, to leave. And I think people know wealthier people pay more in taxes than lower income people. It's just the way the numbers. They pay a higher percentage of the tax revenue coming in. I should say it that way. What's actually happened for the Brits is that the number of millionaires leaving has been way more than what they initially budgeted. So you're getting an exodus out of the country. Wealthy people are leaving Britain because they're fed up with the system here. Maybe that happens here, or maybe they're going to come to Canada. Guys, if we do the right policy changes in Canada, we can attract a lot of this money.
Mm-hmm.
Yeah.
Well, it's funny. I don't know if you guys. I was kind of laughing when I sent it in the group chat there, but Liz Truss, was tweeting. Of course, former finance minister in Britain.
No, prime minister. She was the prime minister.
Sorry, prime minister. She was tweeting. She says gilt rates are higher today than they were in October 2022, which is of course when she got the boot. Yet there was no media outcry or negative commentary from the Bank of England. Britain's institutions are complicit in this huge economic failure. I thought that was kind of funny.
She's not wrong. She's not wrong. I mean, anyone who knows that story quite in depth knows that her finance minister, Kwame, I can't remember. I don't know how to say his name, but his budget was totally uncosted. And so I think she rightfully got the boot. But she's right in the sense that people are so sanguine on the fact that yields are continuing to rise. Growth is much, much weaker in the UK than they expected. And keep their tax base is being hollowed out because all the rich people who pay the lion's share of taxes in this country, in the US. That's by the way, mini sidebar. There's this idea that rich people do not pay, quote unquote, their fair share of taxes is just a demonstrable lie. Like the 1% pay overwhelming, something like 40% of all taxes in Canada and places like the US and the UK, etc. I mean, that's just, I know I'm going to get a lot of hate mail on that, but there's a ton of data to support that view. So don't at me.
So if you took all the billionaires in America, and again, my numbers might be a bit off, and if you confiscated all of their wealth, so all of their assets when they own, I think it's not even enough to cover the deficit there for 1 year. So say you do that, and hey, the deficit now, the budget looks great for 1 year. What happens the following year? You're back to where you were again.
Yeah.
So in Canada,
concept. So now I'm talking about NIMBY, my neighborhood, and then taxing wealthy people. What else can I?
In Canada,
and we talk about immigration. Geez, we're doing the whole trifecta of fringe podcasts.
Top 1% of tax filers, top 1% of income tax filers paid over 20% of federal and provincial taxes in Canada. The top 20% paid over 60% of all of all
It's
taxes.
yeah, one of the big stupid lies that we've been sort of told. There are many. I'm not going to get into them today, but is that like somehow quote unquote rich people don't pay their fair share of tax? That's just not true. That's just now you could say now one can make the case that it should be even higher, and that's I'm willing to entertain that. I don't agree, but I'm willing to entertain that. But just the fact is, the top 20% of income earners pay an overwhelming amount of the taxes.
Oh, so I want to round this out and summarize this. Do you get any sort of signals here? I mean, I certainly do. I mean, this is probably a dumb question, but I just look at, again, sort of, I know we keep talking about this, like the fiscal bazooka, that like governments almost have no alternative, right? Which is the pain from like a deleveraging and cuts perspective. Like Doge, for example, is just too painful that we're gonna have to like grow our way out. And I just look at like S&P all-time highs, gold all-time highs, Bitcoin today 112,000 all-time highs, like. And then, Rich, you're talking about, the long end of the curve pushing higher. I don't know. To me, it's like, you look at these deficits, and well, if you go through a recession, those deficits just balloon out even further. Yeah. So it's like you have to avoid one at all costs.
Yeah,
again,
well,
Keith,
I'd like to avoid. I'd like to avoid the winter. I'd like to avoid the winter in the nighttime, but
I think we are the probability of the next crisis in the financial world. It's going to be the bond market.
Yeah, I think that's
And we haven't experienced that in our lifetime. So if anyone has managed to last into the 64th minute of today's 194th with the Loonie Hour, now you're getting the big punchline here. But no one has experienced a crisis in the bond market in our lifetime, and that means very few are prepared for this. They're not going to know how to react when it hits. And when it hits, it's going to be fugly. It's going to be horrific. And you're going to get a lot of markets moving. You can have some markets, I can't say which ones, just for various reasons, but are going to be going to the moon, and it will not make any sense whatsoever. And that's the kind of, and again, I think we're seeing these little Timbits. They're all making the trail for us, to that final cake, which will be horrible.
That's when the government bond market blows up. That's when they usher in the CBDC.
Oh, please no! But wait a second. I want to end this on a positive.
I have a shirt that says no to that, so we won't.
No to central bank digital currency. But there is a way out of this, and it's just like, but it needs a wholesale change in the philosophy of the people who run our country and many other countries, and that is it. Well, who knows if it won't happen or not? But it is the emphasis on investment, which Carney has alluded to. I'll give him credit for that, and productivity growth. Because that is ultimate, and I know I go on and on and on about this, but like Canada's non-residential fixed investment is at a 20 or 15-year low. We do not invest any money in this country. We just don't. We have a mass exodus of money going to places like the UK, like China, and certainly the US. And in order to improve your productivity, you must invest in capital goods, not real estate. Sorry, Steve. And we need to, and that is a way that you can improve your productivity growth. And if you improve your productivity growth, guess what? You lower inflation, you increase your tax base, all the things that we need to avoid this catastrophe can be solved with a lot of productivity growth and capital investment. Now ask me if I think that that's going to happen. That's a different question. But that is ultimately how you square this circle. And unless you let but we are, in my view, the people in positions of power in this country just don't understand. I mean, this
guy's pretty optimistic. In one room for the weekend, and I promise you, people won't like it. It'll be like the Argentina story. People will call us crackpots and stuff, but it would fix everything.
Yeah. Box of Timbits in there, you'll be all set.
But just when I'm going to share this chart on Twitter today, but just gross fixed capital formation, or CapEx, aka investment in non-residential, which means machinery and equipment, non-residential structures, buildings, mining, industrial equipment has collapsed, and you cannot improve your productivity growth without investments in capital, according to my crush, Carolyn Rogers, and other people at the Bank of Canada. This is well understood within our sphere and our circle.
Maybe the pipelines are coming. You see Dougie Ford just
Dougie Ford, we finally agree on something.
Dougie Ford was not talking about the Bank of Canada this week. He was talking about pipelines being built.
Yeah, that's an example of CapEx. Yes.
So Doug Ford's giving the thumbs up along with Danielle Smith. The only one standing in the way is David Eby. So hopefully he gets out of the way and we can export our energy. Anyways, I think that's a good spot to end it. Boomer, any final parting words? Any last Timbit stories you want to share?
No.
All right. As always, guys, we appreciate the support. If you enjoyed this episode 196, all we ask that you share this episode with one friend or family member as we inch closer and closer to number 200. We appreciate the support, and we'll see you next week.